The Fed are going to kill the stock market. If you want to make money in the stock market, you need to listen to this video to the end. We will teach you how to protect your portfolio from the Fed. Welcome to Traders Never Sleeps. In this video, we're going to be talking about the Fed and how they're going to kill the market. Why did the Fed decide to kill the stock market? The Federal Reserve has a lot of power when it comes to the U.S. economy. The Fed is in charge of regulating the supply of money and setting interest rates. The stock market is an indicator of how well companies are doing. When companies are doing well, they will have more shares and their stocks will be worth more. If they're not doing so well, then their stocks will be worth less and people may decide to sell them off. What will happen next? The stock market crash of 2008 was a major event that led to a global financial crisis. It is not surprising that many people are worried about the future of the economy and what might happen next. In this section, we will take a look at some of the possible events that could happen in the near future and discuss what they would mean for investors. Without further ado, number 10, you want to take out a loan. When higher interest rates are expected, banks also increase the rate at which they pay money borrowers. Danny Elbuck, Chief Executive Officer of Texas-based Lone Star Capital Bank, says that when the Fed raises interest rates, banks follow suit with higher interest rates for all types of loans. Although the U.S. economy has grown, many people still borrow from banks to purchase homes and cars, even though they are not making a lot of money. These loans can lead to considerable debt if borrowers do not make their payments on time or if interest rates go up. To decrease how much financial strain borrowing takes on borrowers, banks often offer mortgages with low interest rates for shorter terms with larger down payments needed for loans like 10-year mortgages and 15-year mortgages. If you borrow money from someone, the interest rate will go up on all types of loans. Also, loans with low interest rates typically have smaller monthly payments and longer repayment periods than loans with higher interest rates. What will you do if you retire soon? Fortifying your savings is another way to protect yourself from unexpected expenses. During recessions, when the economy is down and unemployment increases, older workers are at higher risk of losing their jobs than workers who are in the middle of their careers. You could lose your job if the economy starts to slow down or you start to experience a high level of unemployment. You should have an emergency fund that will help you get a job if that happens. It is recommended that you save at least 3 to 6 months worth of living expenses if you have normal circumstances. Get into the stocks when they are cheap. It's probably not a good time to buy shares because the market is down, but investing now will pay off for you in the long run. If you have good savings, consider investing in sectors that usually perform well in downturns, such as healthcare, utilities, and consumer staples. It's possible to hold on to some of your money by investing in things that are easily accessed like cash and investments that are able to be accessed quickly to help you get through a recession. Short-term assets like cash and investments that you can easily withdraw anytime are usually used within a year to pay bills or pay bills. This helps you avoid drawing on your long-run retirement savings. You can benefit from taking advantage of low tax rates to save money. This could be a good time to convert your IRA into a Roth IRA. You can grow your money tax-free in a conventional IRA and take out money tax-free as you age. You may have to pay taxes upfront, but if you have a qualified retirement account, you can benefit from tax-deferred income in retirement. So it might make sense to start saving for retirement in a traditional IRA rather than a Roth IRA right now. Even though stocks are down in value, your investments will likely be worth less than you thought, which means you won't have to pay taxes on any money you own. Considering that you might be in a higher tax bracket in the future, take advantage of a low tax rate now and take advantage of tax-deferred income in your retirement. 9. You want to know when your money will lose value due to inflation. When interest rates are lower, that forces banks to lend money to people who need that money. Inflation is the rate at which the prices of goods and services are rising. Basically, what you buy now will cost more tomorrow, and that's called inflation. If interest rates are low, inflation can be higher because banks don't have to offer as high a return on loans to keep their customers happy and competitive. Inflation is the rise in the average price of goods and services in an economy over time. Rising inflation can be a sign of a weakening economy when demand for goods declines and companies are forced to increase their prices to maintain profit margins. Inflation can also be caused by too much money being put into the market, which leads to rising prices as there's more competition for limited resources like land, labor, and capital. 8. You need to know when money will have more purchasing power due to deflation. You want to know how interest rates will change if the Fed raises interest rates. This means that there will be a lot of borrowed money out there, which means that the buying power of dollar assets will increase because of the scarcity of dollars that people have. To spend, they must buy an asset like stocks, bonds, or currency. This is called hoarding money, and it reduces the buying power of the dollar due to increasing scarcity. Your money doesn't actually sit in the bank. Your account is a record of how much money you are entitled to withdraw from circulation. 7. You are wondering what type of investment to make and when to not make money from it. If rates go up too quickly, the market could crash because everyone will be selling their stocks and buying bonds. If rates go down too quickly, the bonds could be worth more than stocks, so people might buy bonds instead of stocks. The key to investing is making a similar allocation as what you do with your checking and savings. 6. You are looking to borrow money to purchase things. If interest rates rise, that affects how much your money can be borrowed. If you are working or planning to start working, you will find that fuel, food, and metals are cheaper when interest rates increase than when interest rates decrease. Interest rates affect how much money is needed to purchase a given item. They also affect how much you will earn when you save your money. 5. If you're planning to buy a house or are in the process of buying a house, there are many reasons why high interest rates help to raise the cost of a house, and low interest rates help to drive up the price of a house. If you are a millennial who is interested in obtaining a mortgage, you could save thousands of dollars. If you pay in cash, the lower the unemployment rate, the higher the interest rates go up because people are more likely to borrow money when there is less fear of a financial crisis. Inflation and interest rates affect each other. Lower interest rates increase the money supply, which increases inflation. 4. You are trying to borrow money from a bank or a savings account. When interest rates go up, so do the yields on your loans. You want to borrow money. If interest rates go up, you will pay more for your bond investments. You have money invested in businesses or your retirement account. As interest rates change, so do the yields on loans and bonds. When interest rates are higher, the higher yield compensates for the increased price of borrowing money. As a result, borrowers should not only consider their monthly payments when looking for a new loan, but also the total costs over time. Borrowers should also consider what they might do with their money while waiting to pay off a loan. The market for bonds will go down when interest rates go up. 3. You have money in an account that earns interest. If interest rates are low, it causes money to be worth more. You can save money by paying interest at lower interest rates compared to paying more when borrowing money at lower rates. It is important to keep up with the current interest rates to ensure you are getting the best value for your money. As interest rates rise, money is worth less because it earns less. The opposite occurs when the interest rates fall. 2. You are employed or are looking for a job. You have money in a savings account that pays interest. The Federal Reserve lowers interest rates because it encourages businesses to invest in new businesses and hire more workers to meet demand. When they lower the interest rate, they are encouraging more businesses to invest in new business ventures because they will not have as much risk. 1. You have money to buy things or are planning to buy a business. Business owners set prices based on what they believe will sell well and what customers want to pay. Low interest rates means that your money becomes less valuable.